Good morning, UMortgage. Happy Tuesday. It is Tuesdays, Monday here. I hope you all had a refreshing Labor Day weekend. I sure did. And we're going to be talking a little bit more about labor here further on down the old podcast and talk about the Bureau of Labor Statistics specifically and how many people are belabored of our various inexorable points that we'll be making. But first, Rob, contain yourself, please. I need to introduce myself, Sean Grapevine, Director of Agent Direct, cousin to Agent Connect, as I'm sure you know. I will take the likeness and the names of that program as an homage, not as a bit of thievery by Anthony Casa. And I'm joined here by two men who, like Coco Gauff and Jelena Ostapenko, will be doing shortly in the U.S. Open at noon, I think, or maybe 5, or something like that. They rally the ball of capital markets back and forth at the highest levels, desperate to land a killing blow to all who come against them, notably Jerome Powell, the Bureau of Labor Statistics, and that ineffable bogeyman, transitory inflation. I am joined by the U.S. Open, future U.S. Open 1 and 2 of UMortgage, Rob Pieklo and Austin Koenig. Welcome.
Wow, that was amazing. Sean, I think laborious was another thing that I would say was even just me trying to get my thesaurus up and understand all the words you used at some of the parts. I mean, wow, that was amazing.
When in doubt, confound. That's what I say. You know, make a great politician someday. Just
mission accomplished.
Use them. Yes, thank you.
Big words.
Well, welcome, fellas. Are you guys tennis fans?
You know, actually, I did watch a good amount of the U.S. Open this weekend. It was there's some good matches. It was fun. I liked it. I don't usually watch, but for some reason I watched this time. It's really good.
And I'm dealing with Disney in a dispute with Spectrum, so I can't watch the U.S. Open here right now because my cable provider is in battle royale with Disney.
Embroiled in an imbroglio. Well, I like to bring up vaguely European sports that nobody watches during my intros. I've somehow garnered an interest in the world's most boring sports. Tennis is not among those, but it's close. So, welcome, guys. Labor Day, Bureau of Labor Statistics, jobs numbers. Let's talk about last week. Let's talk about the good news for people who like bad news. In the numbers we got last week and how it's had absolutely no effect on the fixed income markets except for a mere blip. Tell us who wants to take why that happened.
I can go first, and I'll let Rob, to have his own spin on it too. So, yeah, we had a great print of jobs numbers. It was fairly close to expectations, but it technically beat it. But here's kind of the fringe that really helps provide, I think, a good story for the Fed meeting. Actually, as we kind of head into today, we have a Fed meeting later this month. It's, I think, on the 20th, so it's not this upcoming Wednesday. 2 Wednesdays from this upcoming Wednesday, right? There's only a 4% chance they're going to hike. That's what's being priced in the market, especially after that data got released. And it's kind of telling a couple different stories. One, last month's got revised down by a lot. Revision puts it lightly. It really got chopped down completely to almost only 100K jobs added, and I think they printed somewhere in the mid 200s. That's quite a difference. And also we saw unemployment rate hike up to 3.8%. Now, why did unemployment rate do that? A lot of unemployment rate can kind of be misconstrued because no one knows how it's calculated, but a lot of it has to do with who's actually participating in the labor force. That participation rate, we saw a lot of people enter back into the labor market, and that's actually a good thing. That's something that we had happen in the times of the pandemic, where a lot of people left the labor market, just never came back. And so we're seeing that kind of work itself out, but that also helps the supply demand factor, right? We're seeing jobs, not like listings, come down. We're seeing more people come to the market needing jobs, and that means that hot wage growth or anything like that, that's not as much of a worry. It's actually kind of playing into the Fed's hands perfectly of, hey, things are working. Maybe we shouldn't just keep on hiking rates to solve the problem. let's just keep on playing it out. Rob, if you want to take it from there.
Yeah, and then bonds sold off. You're like, wait a second, hold on, wait. I thought we were going to see.
Yeah. All what you said sounded good, Austin. I was kind of stoked on it. I think we all heard good stuff when those numbers came out.
Exactly right, and we saw that, and just seeing like the momentum trade happen, and it was surprising to see the 10-year kind of move and continue to move up. I mean, we're staring at below 410 last week on Thursday, and now we're staring at a 426 print on the 10-year right now, which with data and the holiday and everything you kind of see, you would expected that thing to kind of at least stay stagnant based on the information that we've received. So it's an odd behavior, but that's the market, right? Whenever someone piles into a particular trade or something looks like it's going one way, it can easily do the Kansas City shuffle on you and turn in the other direction.
Classic Kansas City shuffle. Well, it's early September yet. Do we have some news that can move the needle coming up this week or next week, or are we just kind of stuck with sort of rotting on the vine here for a bit?
This is a slow week, to put it all things considered. Next Wednesday is kind of the big headline, right? It's the inflation print. We get the last inflation print, CPI, before the Fed meets, so that's great. But we still haven't hit the Fed quiet period. They haven't really gotten to talk on the jobs numbers, really. So this week could be good to hear from Fed officials talk on the jobs numbers, kind of how they're approaching it, and all that's good stuff. I think it's going to be more of the same of what Jerome Powell said at the Jackson Hole conference. But I think it's good to hear continued perspectives. I don't really think there's anything super major here this week, but we do have the initial jobless claims, of course, on Thursday, and the productivity numbers, which is great. But Rob, does anything jump out to you other than like the minor outline data points?
The things that haven't moved markets will move them again, like they always say, like they've happened over the last couple of weeks. It's just these minor reports are coming out, and people are piling into trades on either side because we're in this cusp, kind of on this line. And you've seen it. The moves have been pretty severe, between 10 and 25 basis points in the 10-year whenever these kind of minute kind of data points come out. So I'm surprised to see the movement that we're seeing. All signs are pointing to MBS underperformance and potentially some people buying in and seeing rates come down a little bit. Inflation numbers are going to be it, but in terms of data points, these are just the standard data points that are coming out this week. Next week, again, with that print, we'll see what that looks like. Inflation obviously is the top concern, so we'll see how that moves markets. But really, it's going to be a waiting game until the Fed meeting and kind of what that looks like, and getting some direction in the presser after, as usual. That's a long way from now.
Yeah, sure is. And what are we seeing in the like long-term viewpoint of economists, traders, markets? Rob, and especially in like the MBS market, are we seeing a coming to terms with like where we're at is going to be where we're staying to a certain extent for the foreseeable future? Our rate stacks are getting juicier and juicier bit by bit at the tail end there. Are we going to continue to see that? Are we going to if we stay here, will there be more liquidity in the upper ranges of the mortgage-backed security market?
Yeah, here's the good and bad of it. The good is it was much more orderly this time around, and we got to the higher stacks faster. We saw people kind of go out and say, hey, you know what, we're drawing a line here. Fannie and Freddie cash windows came out with note rates much higher than they normally would have. Previously, they weren't too slow to move. They understand there's a need for premium in the market, so they moved up in stacks. But those coupons aren't really trading. It's Fannie and Freddie kind of drawing a line in the sand and saying we're going to have to put these note rates out there, and lenders kind of put them back onto the rate sheets as like pretty quick. Normally, it took it was taking 30 to 60 days before we'd see those upper stacks start to show up. So it's become more orderly, we'll call it. The bad part of that is that I think people are now recognizing that it could potentially be higher for longer in terms of rates. So they're seeing that it's not this. It was tough to move because everyone was predicting, and all forecasts were showing that we were going to be much lower, and it was going to move towards at Q2 or Q3 of this year, maybe Q4 now of this year. Now we're into Q1, Q2 of next year. So now they're seeing this higher for longer piece. So those coupons now are going to have a little more validity to it, and you potentially could see some more liquidity when it comes to trading them.
Austin, is that what you're hearing in your whispered discussions in the back rooms with your various lender and investor partners as well, or
Yeah, no
from your old
question.
Goldman buddies?
No question. And what Rob said too is very accurate. And I have to say, just from like a big picture standpoint, that we're talking about, hey, like when's the cut's going to happen? How long? How are they staying? Right. We have to think about this too. A lot of the Wall Street, economists or big kind of thinkers in this sense, they're all bullish on the U.S. economy for the most part. And these things that have been printing out have been kind of the good scenario that everyone was hoping for. It looks like it's more and more likely to happen. Like a recession is a little bit less likely to happen. But the thing is, we don't know is things are less rosy elsewhere. Europe, less rosy in some aspects, but China, especially, we talked about it a couple of weeks ago. Things are not great there. One interesting tidbit is they recently lowered their rates and even their mortgage rates. I think it was like Beijing and Shanghai, their existing home sales like doubled or something crazy like that immediately after doing that. So obviously their kind of policies are having quick effects, but there's still a lot of issues there. And what kind of contagion do we see, right? That takes time to play out, but it's something we can't ignore necessarily. But is that something that's going to make me tell you, hey, lock or float? I saw this thing from China. That might sound familiar a little bit to maybe a couple of years ago, but hey, like we have to be kind of all worldly, a little bit looking elsewhere too. But for us right now, we can't be hoping for anything this year in terms of big cuts or anything like that.
I think it's important to kind of segue into housing as well. If you look at housing and look at the markets and kind of look at the CNBC headlines that they did over the weekend, in terms of housing slowing and it could be turning for the worse. And then you kind of look at the data and it's just a slowing of the growth in housing. So inventory is still an issue. I read the headline and I was like, oh, wow, it turned negative, and it didn't. It was at this, the seasonal adjustment was off.
The derivative of the growth is negative.
It's still up. It's just not up seasonally what normally would be up on average over the last 25 years, but we've also been way ahead of that average for a long period of time. So housing is still kind of the topic, and you're seeing a lot of this being politicized when it comes to the actual way to afford housing right now, right? You're seeing a lot of this, and with an election year coming up, like this is a focal point. This is a talking point. And we're outside of like trading MBS. We're talking about subsidized mortgage bonds. People are talking about it. People are talking about ways to get it more affordable for people. And we still kind of run into the same thing, which is an inventory problem, not a buyer problem right now.
Sure. Yes. Well, I mean, I wouldn't mind politics interfering in our particular marketplace, and just like making a better deal for everybody. Both parties race to the bottom. But unfortunately, like you said, neither party is building more houses, and that's really what we need. So, well, it sounds like we've got kind of a slow week ahead of us. I think the consensus is expect trading in to be range bound, if I'm using that term properly, and that when it comes down to it, when there's volatility, places like UMortgage, or UMortgage in particular, really shine. We have access to the most investors, the most products, the most flexibility, and we're on the wholesale channel. So we've got the best deal for consumers, saving thousands and thousands of dollars for everybody, and especially people who need it most. So while I've got the two of you cornered, your capital markets, the tip top, the absolute icing on the cake here. Can you guys tell me what you're most excited about? Any new products down the pike? Any new lenders we can expect to see for our faithful listeners that have been part of this live stream for 15 whole minutes? Reward them with something. They need it.
Yeah, for sure. We're excited about, we have some new lending partners that are coming on board. We're very excited about taking advantage and having some of our lending partners take advantage of the spec market that's out there right now. And with rates elevated and some opportunities, especially on the lower loan balances and new stories being made in the secondary market, we're looking forward to bringing on some lenders that are going to help us with that. It's hard when you're not a direct lender to kind of directly, have pricing that has that part of it. But with our lending partners now, we now have a nice little subset of folks and new people we're bringing on that are going to help us And when I say new stories, it used to be that, you know, a lower loan balance was the only story, all the way, you know, $100,000 loan or less, or 85,000 or less is really the story that you can sell. Now these things are going up where there's up to 250, 275,000. Some stories even are being written at 300,000. So these are things that we're going to start to participate in with these new lending partners that we're coming in with, along with just overall some pricing power based on our amazing originators and how many loans that these guys are doing and bringing in a market that's down. These guys continue to bring in that, and with volume, you have these opportunities for price incentives as well. So we're looking forward to bringing on some new partners to really sharpen the pricing.
I love to hear it. That's the greatest story ever told. Austin, anything you're excited about?
No, that's exactly what you know. Rob and I are a tandem in that sense. So whatever Rob said, exactly right. Like, we can go into the spec market, and that's actually maybe a good thing to cover lightly in another meeting as well. I know we're running up on time here, but like you said, there's a lot of stories out there, and we need to be able to kind of win together is the kind of the strategy we have with you know, our investor partners. So 100% what Rob said, and we'll have more things exciting to come.
Well, you love to hear it, guys. We got the greatest showman here telling the greatest story ever told. Appreciate you guys' time here on a Tuesday morning, and looking forward to talking to the two of you, or one of the two of you anyway, over the next few weeks, and anticipating the CPI report, Fed meeting, and anything else this crazy topsy-turvy market throws at us. Thanks, boys.
Of course. Thank you,
Thanks
Sean.
for having us.
Thanks, everyone. Let's go get some loans.